we're going to look at how to trade the supply and demand range. Obviously, by now, I'm sure you've been practicing how to draw your supply and your demand zones. You now know how to draw those areas, right?
Yes.
Right. So we are going to talk about the range, how you can trade a supply and a demand range. So first things first, what is a range? This is whereby price is trapped in a consolidation range, like there's no too much movements in terms of price, like it's moving a few pips to the upside and then it moves another few pips to the downside. So price is consolidating, right? What causes consolidations? Consolidation or range in price. This is whereby orders are being built, whether it's from the upside or to the downside. Then eventually you're going to see market spike out of the range, which most people call a breakout. So assessing when a trend has changed is one of the most difficult things that a trader is going to face. Like, how then do you determine that, okay, market is now bullish or market is now bearish? You see, that's one of the most hardest thing. Some people, they use a whole bunch of indicators, RSI, moving averages, to determine if a trend is what has changed. You see, so the reason why this is difficult is that for every time frame, there's always a different trend. If you look at H1, it's got its own trend. Might be a downtrend on H1, but if you look on a daily time frame, it will be an uptrend, and if you look on a weekly time frame, it will be a downtrend. This is all on one asset. You see, say you're looking at gold, so you may find out that gold on H1 is bullish, but if you go to daily time frame, it is bearish. That's why it's difficult to really gauge whether a trend has changed or we are still in a range. So you need to define the time frames you'll be using in your analysis properly and stick to that. That's why I always emphasize higher time frame is important. Make sure you know what's happening on a monthly, on a weekly, and on a daily chart. Do not switch randomly your time frames, like for at 1 minute you're on a H4 time frame, the next minute you're on a 15-minute time frame. This is gonna mess you up big times in terms of you gauging what the trend is. If you are taking your trade, say, on a H4 time frame as your execution time frame, make sure you stick to it and just go to a higher time frame to validate your trade. Don't go lower, because you are going to see a different trend, which is basically going to be, in most cases, opposite to what you want to trade. So you must choose an entry time frame where you'll be highlighting your entry, supply, and your demand levels. After that, define the time frame to analyze how high or how low you are in a range. So basically what we are talking about here, Jerome, in terms of the range, what we're talking about is something like this. So you've got price moving up and down with no clear direction. This is what we call a range. Can you see the illustration that I've done there? That's what we call a range. So when price eventually breaks out, whether it's to the downside or to the upside, it would have clearly defined this range. So now we need to learn and understand how to trade this range. That's what we are talking about today. So if you are too high in a range, too high, it means price is up here. You should be thinking of exiting your long positions. Say you bought down here and then you see price approaching the extreme highs of the range. It means your take profit, or if you are in a trade, you must look toward to close, because anytime price can bounce and go to the downside. You see, same applies if you are in a short position and price is approaching the extreme lows of the range. You need to be looking at taking your profit or close your short position, because price can bounce back up. So what I've designed a criteria that can guide you in observing how high or low you are in a range. I'm going to illustrate this on a chart eventually when we are done with the theory part. So you have to decide how much percentage of the range that you consider is too low or is too high of the range. So for instance, let me clear up this quickly. So let's say you've got your range here and price is moving up and down, right? Before it eventually breaks to the upside or downside. So obviously, you've got your 50% mean threshold, like the pivot point, the 50% from the supply. So this will be a supply and this will be a demand. So in between, we've got the 50% level, right? So for you to consider a zone where you'll be like, okay, no, I think right now price is gonna respect the supply, you need to consider at least 75% of the range. Meaning if price is anywhere in this area here, you are looking to exit your long positions or to add short positions. And then from the demand side, you need to consider at least 25% of the range, meaning down here in this area here, you are looking to be a buyer or to be exiting the short positions that you have taken up here. When you see price approaching this level, you need to be exiting those short positions and add long positions. You understand that part, right?
Yes.
Yeah. So now we're going to the next part where I'm going to illustrate further regarding the supply and demand range. So this is an illustration. I'm going to send you the notes and make sure you print especially this part, print it out somewhere where you've got access, probably on an A3 or even an A4, but make sure it's next to your chart, like your computer where you work. Just make sure you've got a printout of this illustration, because it's going to help you when you are trading in a range. So you can clearly see we've got our weekly supply zone. So this is based on a weekly time frame. So the red area represents our weekly supply. The green zone represents our weekly demand. Now, when you look between the weekly and the weekly supply and the weekly demand, we've got a total of 500 pips, meaning our 50% is coming in at 250 pips. That gives us 250 to the upside and 250 to the downside. Now, the demand zone, 35% and lower. You see, if price is 35%, that means price is in this range all the way into the demand. If price is in that range, you are looking to be a what? You are looking to be a buyer. There's no need for you to be looking to short the market here in anticipation of a breakout, because You don't know whether that breakout is going to happen, you see. But
Okay.
the odds of price bouncing on this weekly demand will be very high. You see? So now to the upside, if price is 85% or higher, you do not have to be looking for buying opportunities there. You are looking to take your profit on the long positions that you have taken when price was down here. You see, if you bought down here on the demand and you see price approaching 85% or higher of the range, then you're looking to be what? A seller. That means you are taking profit from your long positions. You understand that part, right?
Yes, yes, yes.
Yeah. So it's very important that you understand this illustration, because once we go to the charts, it's going to help you. Yes, in terms of pips, this is for illustration. You can have a range of, say, 100 pips. You can have a range of 200 pips. You see? So always make sure that when you have defined a supply zone or a demand zone, and then you see price respecting those weekly zones over a period of, say, 2 3 weeks, that's like 20 days. If you see price ranging, then you need to make sure you've got the tool for you to capitalize on trading that range. This is where the criteria comes in. That's how you trade in a range. So now, when you have your range defined, what configurations now are you going to use to be trading? What I mean by configuration is in terms of your entries. Are you going to be a day trader? Are you going to be a positional trader? Or are you going to be swing trading? So this is swing trading configuration is the best time frame for medium term trade setup. So this is basically where you do your analysis. You do your analysis on a weekly chart, right? Your analysis is based on a weekly chart. So this is where your supply and demand range and directional bias is on a weekly chart. So your intermediate range is on a daily chart, is your intermediate supply and demand range and directional bias. So your execution is going to be on the H4 time frame. So this is a swing trading configuration. If you are going to be doing, if you're going to be doing intraday trading, meaning you are going to open a position, say today, and then you are looking to exit that position probably tomorrow or by the end of today. It means your higher time frame analysis or your directional bias for that trade has to be based on a daily chart, meaning your zone, whether it's a supply zone or a demand zone, is based on the daily chart, and your intermediate range is based on the H4 chart, and your execution time frame is H1. Most people, this is what they use, because most people, they're intraday traders, and you do get scalpers. I didn't include scalping here because I believe it's not ideal trading way, though people make money out of it, but over a long period of time, I don't think it's sustainable, because you can't be trading on 1 minute or 5 minute chart your whole life. You are going to be messed up mentally. Then we've got positional trading, right? Positional trading now is if you have, say, huge equity, because your higher time frame now is now based on a monthly chart, right? This is where you're going to define your supply and demand range, and your directional bias is going to be based on a monthly chart. Meaning, if you enter a trade, you're basically, you might even wait for the monthly candle to close before you decide whether you're going to close that position or you're going to take a loss. So your intermediate range on the positional trading is based on a weekly chart. That would be your intermediate range. and then your execution and trade management is going to be on a daily chart. So it means you're going to be making your entries using the daily time frame. So positional trading, it requires a whole lot of patience because you might have to hold the trade for even 2 months, you see, for a positional trade. But for intraday trading, you can hold a position for 24 hours, 48 hours, and if it keeps going in your direction, you can hold it for like a week or even 2 weeks. You see, that is if the trade is going in your direction. So these are the trade configurations that I advise people to use, the guys in the mentorship and everyone. I advise you, especially intraday trading. It is ideal to start on intraday trading because it's going to give you more opportunities. You see, you're going to get more trades on intraday than the trades that you're going to get on positional trading. Positional trading, you might get maybe one entry per month, you see, but you're going to see that that entry, if you do it properly, it can yield maybe 500, 700 pips by the time you close that trade, but that will be probably after a month or 2 months. Not everyone is patient enough to hold a trade that long. You get my point, right?
Yes, yes.
Yeah. So then how do you define a trend using supply and demand? So regarding an uptrend, meaning price is what? Is bullish, right? Demand zones are being respected. It means price is failing to break to the downside. And then supply zones are being eliminated. So you can basically see that, okay, we've got price moving higher, then we have a new demand, then price moves higher, then we have a new demand, then price moves higher. So this is whereby demand zones are being respected because you've got a demand, 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 then price keeps going high. So this is a definition of an uptrend. A higher high should remove the previous supply. So we've got a higher high here, but it was removed here, meaning it was engulfed going to the upside. That means this supply zone is now violated. It's no longer invalid. But when price comes back to it, you look to be a what? A buyer. Then this one also becomes violated. When price comes back down here, you look to be a buyer and going to the upside. So this is how you define an uptrend. A higher high should remove the previous supply in order to validate the demand zone. You must always ask yourself whether the preceding supply has been eliminated. Has it been violated? Has it been engulfed? Now, coming to a downtrend. In a downtrend now, it's the opposite. Supply zones are being respected and demand zones are being eliminated, as in they're also being violated. A lower low should remove the previous demand to validate the supply. So you can have market moving downwards, then we have correction, then we have a lower low formed here, right? Then when price comes and rally pass through it, this demand is now violated. And then we have a new low formed here. When price comes back to this old low here, you look to be a what? A seller. Okay? And then this one also gets eliminated here. So when price comes back up here, you look to be a seller. That defines a down trend. These are the basics which whenever you open a chart, you must always be in a position to read what the chart is telling you. be in a position to identify whether market is in an uptrend or market is in a downtrend. Ask yourself this: what type of trading are we dealing with here? Are you trading the correct supply or the correct demand that you see on the chart? Always aim to trade those areas where institutional traders leave a mark. Remember, leaving a mark, it means we have, say, a last up candle there, then price massively drops away. So when price, the big candles, when price comes back here, you are looking to be a what? A seller. You see? And the opposite applies. From the downside, let's say we have our last down candle, and then we have a massive candle that moves to the upside. When price comes back down here, you're looking to be a what? You're looking to be a buyer. Yeah. So these are the basics that you should always ask yourself when you open a chart. You see? Open a chart, you read a chart, go to a monthly chart, weekly chart, understand what those time frames are telling you. Because if you don't get that right from the word go, then whatever decision you make, they're not going to be right. You're going to make wrong decisions, or probably maybe wrong assumptions. So what factors do you have to consider when choosing supply and demand zone? Number one, what has the zone achieved, right? This is basically you trying to come up to a conclusion whether the level has been respected, or how many times has it been tested, or how many times has price gone back to that supply or to that demand level. The moment you see a supply zone or a demand level being tested 5, 6, 7 times, then you need to be very careful, because that level has probably achieved what it wanted to do, as in entice people whether to buy or to sell. Number two, you need to consider the strength of the move. The bigger the candle, the stronger the level. You see, the bigger the impulsive move, like those big candles, the bigger they are, when price comes back to that level which the big candle has broken, those levels, they are very ideal to trade from. What is the risk and reward ratio? Remember, risk and reward ratio, you must always aim for 1:3. So if you have a stop loss of 20 pips, make sure at least you get 40 or 60 pips from that trade. You see, 1:3 or 1:2. Don't open a trade and then you have a stop loss of say 10 pips, right? But then when you see the trade going in your direction after 5 pips, then you close that trade. That's not, yes, the trade will be in profit, but that's not good risk and reward ratio to use, because probably after you close it for 5 pips, that trade might even move 20, 40 pips in your direction. Then you're gonna left to ruin your chance. Number 4, the location of the supply and demand. When we say the location, supply and demand zone that are highlighted on a monthly chart, they are very strong levels. So if you have a supply zone that is marked on a monthly chart in relation to a supply zone that is marked on an H4 chart, the one on a monthly zone is more ideal to trade from. Number 5, the quality of the base, right? The base is basically when price moves, say it drops, then there's a correction or a consolidation, then it also drops again. This is what we call the base, right? When price has been ranging, this is what we call the base. So you might get price dropping, and then there's like 2 candles, and then it drops. This one here the one with 2 candles, is more ideal to trade from when price comes back. This one with a big consolidation is not that ideal because the orders that have built in both sides of the range makes it impossible in most cases to trade. So you find out that this base might not hold and price will come back to it but keeps going high. You understand that part, right?
Yes, yes, yes.
Yeah. And then we've got what we call confluence, more of like a correlation. So these are factors that you should consider. So for example, we've got dollar index. If dollar index is trading at a higher time frame supply and the euro is at a higher time frame demand, we have to go long on euro USD. You see, that's confluence. If dollar is weak, you are looking to be long on euro USD. You are looking to be long on the precious metal, which is gold. You see, but if dollar is weak, then you are looking for euro to be strong. That's confluence. Those two work hand in hand. It basically means you are going to make more trades from the other asset. We're going to talk more about confluence in the next 2 or 3 classes from now, because there's a whole lot of notes and things that you have to know in terms of confluence. So these are some of the factors to consider and should be taken into account when a zone, for which zone to trade from. And finally, less is more. You see, don't always aim to rush to make sure, no, I need to be in a trade. I need to be in a trade. I need to be trading. Monday market open, you're looking to jump into the market. No, that's not ideal. Make sure you understand what the market is doing. The moment you accept that you are not in control of the market, your ego needs to be in check, then you would have taken a huge step. The markets don't care about you. The markets, they've got no emotions. You see, Forex market is where people express their belief about the exchange rate of certain assets. So don't be a zombie, like an MT4 zombie, to say almost every time you are there on the chart looking for trade setups. That one is not sustainable. You eventually be just blowing your accounts. Make sure you've got your zones highlighted, you've got your levels highlighted and marked. Only when price comes to your level that you have highlighted, then you look to what? To be in a trade. Not to say there's no trade, you jump onto a 15-minute time frame, 5-minute time frame, then you're looking to sell without considering your analysis. That's not
So, yeah.
good. Yeah. So less is more. And then finally, before I go to the chart to show you so this is just basically a summary of what we have been talking about for the past 30 minutes. So I'm gonna send you these notes as soon as we are done, and then the video, I will upload it and then send you the link. Right. So for the illustration of a range, I've got dollar index here, right? Now you can clearly see on the chart, dollar index has been moving down, right? It has been bearish, right? But if you look from 29 July up until 22 or 20 September, let me highlight that range for you. If you look from here up until there, you can see that price has been in a range, right? I think I sent an
Right.
assignment. Yeah, I think I sent an assignment on the group regarding this. You can see that price was going up, then it comes down, goes up, comes down, goes up, then it comes down. Eventually, it broke out, right? So now, how then do we trade that range? So what you need to do, once you have seen, obviously the range is going to be defined after the first two highs or two lows of the range, meaning you are looking at this area here. Let me highlight that for you quickly. You are looking at this high and this high, you're looking at this low and this low, right? So the moment you have those formed, you highlight the area, right? Because you are anticipating price to respect those highs and lows. Because otherwise, if we have been bearish all the way like this, then we start seeing price moving up, down, then we've got another leg up, and then it moves down.
Down.
From there now, you've got a range that has been defined, meaning every time price approached this level, every time price approached this level here, you would have been a what? A seller.
Seller.
Every time price approached these lows here, this area, you would have been a buyer.
Buyer.
You see? That's how you trade in a range. Now, in terms of in terms of marking it now on the chart, right? Once you have seen the two highs formed, already this is we are on a daily chart. So this is our first high, we've got our second high. Now you can see already this candle here, it moves away from a level. So we've got the last up candle. Just a minute. This is our last up candle, and then we have an impulsive move away, which closed way below, meaning this is our what? Our supply zone. You see? Now price comes back here, then it respects that zone. Yes, there's a few touches. This is a daily time frame with the second touch. The third touch, price dropped. This drop here on a daily time frame, the opportunities that it gives you on Euro USD, on USD JPY, on AUD USD, on NZ USD, they are endless. So you find that those 2 days, that those bearish candles that I've just highlighted now, those 2 bearish days, you could have got more than 100 pips on Euro USD, USD JPY, on GBP USD, because you are doing the opposite. Only for USD JPY, you trade it the same way as dollar index. If dollar index is going to the downside, you also go lower on USD JPY. If dollar index is bearish, Euro USD is going to be bullish, meaning you'll be hunting for long position on Euro USD. Now, if you look again from the downside, we've got our last down candle there. When price comes back, you can see the first drop, it came back, then it rallied. So you look to be a buyer down here because price has been just ranging. And then eventually, when price broke out here, you see this candle here, this is when price broke out of the range here. Now the chances that today's candle is gonna hold, they are very likely, you see, meaning we might see a bounce to the upside where current price is on dollar index, because it's now a supply zone that has been engulfed. Now it means it's gonna be a demand zone. But now with the market conditions that we are in at the moment, it's things that you have to consider. You see, there's a lot going on politically, and fundamentally there's a whole lot of things going on. So we might see price come down to this demand zone before we see a bounce to the upside. So this is how you trade a supply and demand range. So I'm gonna send you the notes in a moment, but I don't know if you have any questions regarding what we talked about today. And I'm gonna send you, I think it's Euro USD. Just for practice sake, don't worry about being perfect or being precise and everything. For practice sake, first thing I want you to do is to mark the range on Euro USD. There's on a daily time frame. There is a range. It is already passed. It's something like what I've just done here. I just want you to highlight the range high and the range is low. Then we'll take it from there. Yeah. So I don't know if you have any questions or something that you want me to explain.
Not at the moment. I will ask you.
Okay. Yeah, don't be shy to ask, even on Telegram, even anytime. Don't wait for the class or anything. You must send the questions so that you can understand.
Okay, sir.
Yeah. So yeah, I'm gonna send you the notes in a moment, and we can take it from there.
Okay, sir. Thank you very much.
All right. Thank you, Jeroma. Have a great evening and get well soon.
Okay, you too, sir.
All right. Okay. Bye-bye.
Bye.